Have you ever wondered how people make money from the stock market or why it feels so complicated? Today, we're breaking it down step by step in the simplest way possible. From understanding what stocks really are to how prices go up and down, by the end of this video, you'll see the stock market isn't some mysterious place for experts. It's a tool anyone can learn to use. Whether you're thinking about investing for the first time or just curious, stay tuned because we're making the stock market easy, exciting, and beginner-friendly. Today we will talk about Stock Market Explained for absolute beginners. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is the stock market? The stock market is a marketplace where shares of publicly traded companies are bought and sold. Each share represents a small ownership stake in a company. Companies issue shares to raise capital for growth, operations, or expansion. And investors purchase these shares to potentially earn profits through price appreciation or dividends. The stock market is made up of various exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, where buyers and sellers interact. For beginners, understanding that the stock market is not just a place, but a system that reflects company performance, investor sentiment, and economic conditions is key. Stocks are influenced by factors like earnings reports, market trends, news, and global events. While investing carries risks, the stock market provides opportunities for wealth creation over time. By learning how it functions, beginners can start making informed decisions instead of relying on guesswork, creating a foundation for long-term financial growth. 2. Why people invest in stocks. People invest in stocks primarily to grow their wealth over time. Unlike savings accounts, which provide minimal interest, stocks offer the potential for higher returns through capital gains and dividends. Investors also buy stocks to diversify their portfolios, balancing risk across different assets. While stock prices can fluctuate in the short term, historically, the market has grown over the long term, rewarding patient investors. Investing in stocks allows individuals to benefit from the success of companies and the broader economy. Beginners should understand that investing is not a get-rich-quick scheme, but a disciplined strategy to build wealth gradually. Stock ownership also provides an opportunity to participate in corporate growth and profit sharing through dividends. By understanding why investing is essential, beginners can approach the stock market strategically, balancing risk with long-term financial goals, rather than making impulsive decisions based on short-term market movements. 3. How stocks are traded. Stocks are traded through exchanges, where buyers and sellers place orders. Trades can happen electronically or on physical trading floors, though most modern trading is digital. The stock price is determined by supply and demand. If more people want to buy than sell, the price rises. If more people sell than buy, the price falls. Investors can place market orders, which execute at the current price, or limit orders, which execute only at a specified price. Brokers, both traditional and online, act as intermediaries, facilitating these trades for a fee or commission. Understanding how stocks are traded helps beginners know where, when, and how to execute their investment decisions. It also highlights the importance of monitoring market conditions and using proper tools for research. Trading is not just about buying low and selling high. It's about understanding market dynamics, order types, and the mechanisms that determine how shares move. Knowledge of trading fundamentals builds confidence for informed investing. 4. Types of stocks. There are different types of stocks to consider. Common stock gives shareholders voting rights and potential dividends but carries market risk. Preferred stock offers fixed dividends and priority over common stock in the event of liquidation, but usually lacks voting rights. Growth stocks are companies expected to grow earnings faster than the market, often reinvesting profits instead of paying dividends. Value stocks are considered undervalued compared to their intrinsic worth, offering potential for price appreciation and dividends. Blue-chip stocks are large, established companies known for stability and reliability. Understanding the differences allows beginners to select stocks that align with their risk tolerance, goals, and investment horizon. Diversifying across types of stocks reduces risk and creates opportunities for both income and growth. 5. Understanding risk and reward. Investing in stocks involves risk, but also the potential for reward. Stock prices fluctuate due to company performance, market sentiment, economic conditions, and global events. While the stock market has historically provided higher returns than other investment options, losses are possible, especially in the short term. Beginners must understand their risk tolerance and invest accordingly. Higher potential returns usually come with higher risk, while conservative investments typically offer lower returns. Understanding risk management techniques, such as diversification, long-term investing, and periodic portfolio review, helps reduce exposure to losses. By balancing risk and reward, investors can make informed decisions that align with their financial goals and comfort levels. Recognizing that volatility is normal and staying disciplined allows beginners to participate confidently in the stock market, leveraging opportunities while protecting against unnecessary losses. 6. How dividends work. Dividends are payments made by companies to shareholders, usually from profits. They provide a steady income stream in addition to potential capital gains from stock price appreciation. Companies that pay regular dividends are often established, stable businesses. Dividend investing can be a key strategy for long-term wealth building, as reinvesting dividends allows compounding to increase total returns over time. Beginners should understand the difference between dividend yield, the annual dividend relative to stock price, and dividend growth, how dividends increase over time. While dividends are attractive, not all stocks pay them, and high dividends can sometimes indicate riskier investments. Incorporating dividend strategies into your investment plan provides both income and growth potential, making it an essential concept for beginners who want to participate actively in stock ownership while benefiting from consistent returns. 7. Stock market indexes. Stock market indexes track the performance of a group of stocks to provide insight into market trends. Popular indexes include the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite. Indexes serve as benchmarks for investors to compare individual stock performance or measure overall market health. Index investing, such as purchasing index funds or ETFs, allows investors to diversify automatically, reducing individual stock risk. Beginners benefit from understanding indexes because they provide a snapshot of economic performance, sector strength, and investor sentiment. Index-based investing is a low-cost, long-term strategy suitable for those who want exposure to the market without managing individual stocks actively. 8. The role of brokers and online platforms. To invest in the stock market, beginners need brokers or online trading platforms. Brokers act as intermediaries, executing trades on behalf of investors for a fee or commission. Modern online platforms have made trading more accessible, often offering zero-commission trades, research tools, educational resources, and portfolio tracking. Understanding the role of brokers helps beginners navigate account setup, investment selection, and trade execution. It also highlights the importance of selecting a platform that aligns with your needs, fees, and desired level of support. Using reputable brokers and platforms reduces the risk of errors or fraud and simplifies the process of investing consistently. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.